Hey everyone, it's Finance Legends, and I have a serious question for you. Have you ever felt like the entire system is rigged against you? Why do record highs on Wall Street coincide with your dwindling purchasing power? Why do governments constantly print money, making you pay the price? Every new empire and government seems to invent a new set of money rules. But here's the massive secret. Money obeys laws. Deep, stubborn, fundamental laws that don't care about politics, promises, or optimism. These laws aren't taught in schools. They are survival codes discovered over centuries of economic crashes. If you don't know these laws, you're playing blind. Tonight we're going to unveil the long-lost laws of money. From debased coins in ancient Rome to the digital tricks of central banks today, we're exposing it all. You'll finally understand why the game was never fair to begin with. Let's start with the most basic and brutal rule, Gresham's Law. Back in the 1500s, Sir Thomas Gresham explained this concept to Queen Elizabeth I. Bad money drives out good. The principle is ridiculously simple. If two kinds of currency are circulating at the same time, one trustworthy and the other debased, what will people do? They spend the bad money and hoard the good. Look at Rome, for example. When the silver denarius was gradually mixed with base metals, its citizens weren't fools. They paid their taxes and debts with the new, inferior coins and hid their older, purer silver away. The same pattern emerged everywhere kings tried to cheat by clipping coins or replacing gold with copper. The lesson here is clear. If rulers try to rig the system by debasing the currency, people adapt. They spend the fake and save the real. Once that cycle begins, trust in the currency is lost. However, there's a second law that is almost like the evil twin of the first, Thiers Law. Named after Adolphe Thiers in 19th century France, it states that during times of true collapse, the logic flips. In a crisis, the good money drives out the bad. Imagine Weimar Germany in the 1920s. Prices doubled every few days, and you needed wheelbarrows full of banknotes just to buy a loaf of bread. In that environment, no one wanted to hold the state's marks any longer than necessary. People fled to dollars, gold, and even cigarettes, anything that held real value. We saw the same panic in Zimbabwe and Venezuela. According to Gresham's law, the system breaks completely when people abandon the state's promises altogether. Gresham describes the slow decay of money. Thiers describes its sudden, violent death. But what happens in the tricky gray area between slow decay and total collapse? That's where the Cantillon Effect comes in. It's a law that reveals why inflation always feels fundamentally unfair. Richard Cantillon, an Irish-French economist in the early 18th century, observed this phenomenon. When new money enters the economy, it does not affect everyone equally. Those closest to the source, the government, central banks, and the financial elite, spend it first. By the time it trickles down to workers and savers like you and me, prices have already increased. The early recipients buy assets and goods at yesterday's prices. The late recipients are stuck paying tomorrow's prices. The Cantillon Effect explains why money printing enriches Wall Street but punishes Main Street. It also explains why quantitative easing after the 2008 crash boosted stock markets but left your wages stagnant. Inflation is not just a number. It is a transfer of wealth. And you are consistently not on the winning side. The cruel irony? The system is literally designed that way. The system funnels benefits upward while disguising the cost as just rising prices. Ordinary people feel robbed but can't identify the thief. The Cantillon Effect is the hidden mechanism that has been rigging the modern financial system since the first coins were struck. The rich don't just earn more, they literally receive money differently. While the Cantillon Effect explains why new money flows uphill, financial repression explains how governments ensure that you can never climb out of the valley. The term was coined after World War II when nations were facing enormous debt. Raising taxes could have sparked a revolt. Defaulting would destroy their global credibility. So they found a different way, trapping citizens inside the system and quietly draining their wealth. How did it work? Central banks kept interest rates artificially low, often below the rate of inflation. This guaranteed that your savings account would lose real value every year. Meanwhile, capital controls limited your ability to move money abroad or purchase alternative assets, such as gold. Citizens were stuck earning negative returns while governments were inflating away their debts. This was a silent form of taxation that was invisible on the surface, but devastating to your net worth over time. Fast forward to today and you'll see the exact same playbook. After the 2008 crash, interest rates remained near zero for over a decade. Savers lost trillions in real wealth, while asset prices soared. Then, from 2020 to 2021, rates collapsed again, and we watched our savings erode as housing and food prices spiked. This was no accident. It was financial repression, updated for the 21st century. The terrible beauty of it, from the government's perspective, is that most citizens never realize what hit them. They just felt poorer without knowing why. But these laws aren't just personal. Some operate on the scale of entire global economies, which brings us to Triffin's paradox, the reserve currency trap. In the 1960s, economist Robert Triffin warned U.S. Congress about a fundamental flaw. As the world's reserve currency, the U.S. dollar had to be available to finance global trade. This required running trade deficits, spending more abroad than it earned, to provide the rest of the world with the necessary liquidity. In the short term, this was beneficial. Global commerce exploded, but in the long term, it guaranteed instability. The more dollars the U.S. exported, the weaker the link to gold became, and the more fragile trust became. Triffin's warning came true in 1971 when Richard Nixon ended the gold standard. The paradox is brutal. In order to remain the world's reserve currency, the U.S. must sacrifice the health of its own economy. The dollar's dominance propped up Wall Street but hollowed out Main Street. This system, which gave the U.S. unmatched power for decades, now contains the seeds of its inevitable downfall. That's the Triffin paradox. The reserve currency is both crown and curse. Triffin's paradox shows how the global system is trapped. Goodhart's law explains why every attempt by central planners to manage it makes things exponentially worse. In the 1970s, economist Charles Goodhart made a simple yet devastating observation. When a measure becomes a target, it ceases to be a good measure. Governments and central banks are obsessed with numbers. Inflation at 2%, unemployment at 5%. These metrics are supposed to describe reality. However, when politicians decide to hit these targets at all costs, they distort the system itself. They manipulate interest rates, inject liquidity, and fuel asset bubbles just to make the numbers look good. While the official numbers scream stability, real life screams instability. Goodhart's law reveals the ultimate trap. When you manage the numbers, you stop measuring the truth. Finally, here is the last law in our series, the law of diminishing returns on debt. It's neither ancient nor elegant, but it's the brutal arithmetic of our age. Early on, debt is like rocket fuel for expansion. Borrow $1 and get $1 of GDP growth, maybe more. Over time, however, as debt piles higher, the return drops. $1 of new debt might buy only 50 cents of growth, then 25 cents, and eventually less. Eventually, debt keeps climbing, but growth stalls. The machine doesn't accelerate anymore, it just groans under the weight. We are living in that stage now. Each new borrowing spree produces less real wealth. It merely props up financial markets and maintains the illusion. Debt saturation is the endgame that every empire reaches. This law is merciless. Borrowing only buys time, not escape. In the end, debt consumes itself. So after all these rules, what's the main point? It's simple. Money isn't a mystical force. It's governed by rules as rigid as the laws of physics. We've seen how bad money pushes out good money until the whole system collapses. We've learned that in a real crisis, you should invest in sound assets. We've explained why new cash always makes the rich richer first. We've seen how governments quietly squeeze their citizens to eliminate their own debt. We know that reserve currencies are destined to become worthless, and that debt will ultimately destroy the empire. These aren't just dry academic concepts. They are your survival codes. They explain why inflation feels like theft, why your wages never keep pace, and why your mortgage feels heavier while the stock market celebrates. This isn't random bad luck. It's the predictable rhythm of financial history. The hardest, coldest truth of all is this: the game was never designed for you to win. Ordinary people live under a spotlight of transparency, while the elites operate in total secrecy. You file your taxes while they shift their assets. You earn a wage while they receive the newly printed money first. You hold cash that loses value, while they hold assets that constantly rise in value. The system plays by its own fixed laws, and unless you learn them, you will always be operating blindly. History may not repeat itself, but the laws of money remain constant. If you don't understand them, they will still crush you. If this gave you a new perspective, hit that subscribe button. The answers are hidden in history, and I'll show you exactly where to look.